It is 1 p.m. East African Standard Time. Good afternoon. My name is Geofrey Karubanga, a tutor at MAT ABACUS, and I'm making a follow-up on the mock that took place in October, and I thought I could shed some light on some key questions, but specifically question 1. This is Advanced Financial Management, commonly known as AFM CPA Paper 15. Let us look at the question. This MAT ABACUS Business School mock examination for the December Diet 2025, and the paper took place on Saturday 25th October 2025, and this is Advanced Financial Management, which disturbs very many students, and we thought we could give you some highlights. But as a student, please note, it is always important you read the instructions. These instructions, time allowed, the paper is for 3 hours and 15 minutes. The first 15 minutes of this examination have been designated for reading. You may not start to write your answer during this time. This is a standard rule which you must respect. We should get to know that section A has one compulsory question carrying 50 marks. And that's why we're going to spend our time for the purpose of this video to highlight key issues in that question, and we say how you should have responded to it. Section B has 3 questions, and you're supposed to choose only 2 questions. Each question carries 25 marks. Relevant formulae and tables are provided, and always instruction number 5, write your answer to each question on a fresh page in your answer booklet. Now when you look at question 1, it is important we first read the required. The required, let us understand. They say prepare a report to the board of directors through the managing director that includes an evaluation of the financial viability of the investment in power energy drink using IRR. So the tool has been mentioned, 21 marks. Part B is a continuation, an assessment of the sensitivity of the investment in power energy to initial outlay, discussing any limitations to your assessment. Another 4 marks, making a total of 25. Then part C, an evaluation of any 3 techniques that GBL can use to reduce on the level of uncertainty during the investment appraisal. And then D, an evaluation of all the 3 proposed investment using the profitability index, 7 marks. E, a discussion of the drawbacks of using Islamic finance to organizations like GBL, 6 marks. And a discussion of 4 elements or responsibilities of an ethical framework for an organization like GBL, 6 marks. We have always advised, always begin with the easy marks, and the first easy mark is actually to write a report. Now, in your exam, when you're writing a report, remember you're doing a manual paper, If this is where you're going to put your profile, then the report will appear on the next page. This is where you will put your report format, but you will complete it when you have finished the workings, or what we call the appendices. Then the NPV layout will appear on this page, and then the workings will follow, or the appendices to the report. So when you're writing your report, you need to address it. But before you address it, let us first get some key highlights. When we look at capital budgeting, this is a key topic at advanced level. Capital budgeting, also known as investment appraisal. Whenever you are doing this, you must pick interest and have a concern for relevant cash flows. In that question, you must be able to know that you will need to pick relevant cash flows, and thereafter the relevant cash flows will help you in appraising that project. But you need to know, where do you apply the relevant cash flows? We should be able to know that whenever you're dealing with investment appraisal, cash flows will be divided. Tools you use will be divided into what we call non-discounted cash flow techniques, and on the other hand, we shall have the discounted cash flow technique. Under the non-discounted, this is where we have the accounting rate of return, and we also have the payback period. But on the other hand, under the DCF, it's where we have tools like NPV, the net present value. We also have tools like the internal rate of return. Then we have got the profitability index. We might also have the discounted payback, period. And then finally, we might also have ESC, equivalent annual cost, vis-a-vis equivalent annual benefit. These are key tools that you need to know. Now, when we look at this paper, what tool did the examiner ask you about? The examiner is talking about IRR, and later in part D is talking about profitability index. Therefore, we are going to carry out the evaluation of this project using IRR, and then later, part D, we shall need to carry out the investment of proposed 3 projects. There seems to be other 3 projects, and in that case, we shall use profitability index. Now, when we come back to IRR, the internal rate of return, this is an investment appraisal tool that for you to succeed, you'll need to identify relevant cash flows, because you'll need to lay out your NPV table. And you know, IRR is a tool that actually we get through a try and error approach, and in most cases we use a formula to estimate it. A minus B into B minus A, whereby A, capital A, is the positive NPV, capital B is the negative NPV, and yes, of course, small a is going to be, small a is the discounting rate you will use to get the positive NPV, and the small b is the discounting rate you will use to get the negative NPV. Because IRR commands that you must have 2 NPVs, one positive, one negative, and then that formula will help us to estimate. The next concern should be what are relevant cash flows. If we got the revision kit that was provided to you during revision, the revision kit that was provided to you, this is where I defined what relevant cash flows. So we are going to first review cash flows in capital budgeting. We are saying in evaluating the viability of a project, cash flows and not accounting profits are utilized because the use of cash flows is consistent with the goal of shareholders' wealth maximization, which is always maximizing the present value of the future cash flows. And once you talk about present value and talk about future cash inflows, you are likely to receive the future cash flows in the equation. They must be discounted back, and therefore you will get present value. We are saying cash flows are never distorted by accounting profit policies of any business. And it is cash that is always committed to a project, and therefore it is prudent to evaluate the project in terms of cash inflows. Examples or relevant cash flows. We are saying relevant cash flows. We should consider all the cash inflows and outflows that are induced, mark the word, are induced by the project, by the project or investment. Relevant cash flows consist of all the additional costs and income that will result if the proposed investment proceeds. They are incremental since they are directly or indirectly related to the investment being appraised. Existing costs should be excluded from the cash flows because they would be incurred regardless of the project being appraised. That is the brief about relevant cash flows, and specifically we've got some examples in capital budgeting. The cash price of the asset you pay to acquire the asset, and therefore you might need to install that equipment, and hence installment costs will be capitalized. If you transport and pay insurance on transit, if you pay VAT and import duty etc., these will be capitalized in order to determine the initial cost of the equipment. Opportunity costs or foregone profits after undertaking a project. This is a relevant cash flow that we need to incorporate. Operating expenses such as labor, raw materials, overheads, marketing, customer care, advertising, etc., provided they are directly related to the project or investment, must be considered. Tax payable from the income generated by the project, incremental fixed costs as a result of undertaking the project, capital allowances or tax allowable depreciation, redundancy costs, etc. Demolition costs, decommissioning costs, scrap value, but you should not for scrap value, it is always an inflow and recognized in the final year of the project. Working capital is also a relevant cash flow. But the examiner at times will always provide some non or irrelevant cash flows that you must be able to identify and leave them out. The key one could be market research costs or research and development expenditure, consultancy fees, etc., provided they were paid before the project is undertaken. They are treated as historical costs. Cost of existing assets, for instance, machinery. If machinery is installed in an existing building, the cost of the building is irrelevant. Fixed costs, which remain constant after installing one additional machine, is irrelevant, etc. That is the background I could give you. And whenever you have been told to write a report, whenever you have been told to write a report, we take a memo format. You'll need to address it to who, from who, the date. It is always important you put the exam date. Subject, in this case we are doing evaluation of the project. You should be able to introduce that possibly I submit this report in fulfillment of my engagement terms as a financial consultant of the company. The report consists of evaluation of the financial viability of the proposed investment, sensitivity analysis, etc. All these other parts that form the question will be put in the introduction here. Then you begin responding either to question 1A or 1D. In this case, you will be looking at 1D, which is evaluation of the proposed investment. This is where you will be able to draw your conclusion after you have done your workings and or what we call appendices, which you will attach to this report. That's where you will be able to say the proposed investment is financially viable provided the NPV is greater than is positive. But if you're dealing with IRR, you will compare it with the cost of capital and be able to draw that conclusion. Then from there, you can go to part B, etc., and answer the question professionally. But you will need to know how, in order to do IRR, you will need to carry out an NPV layout. You will need to carry out an NPV layout, and therefore, if the project is 4 years, you should be able to tell us what is the revenue, and therefore, if there are variable costs, if there is anything like fixed costs and other costs, you should be able to bring them on board, subject them to that revenue, such that you get taxable profit and all cash flows before tax. You will be able to charge your tax, and then you bring these other costs or inflows or outflows like tax relief on capital allowance. Opportunity cost, the examiner could tell it is after tax. If it is after tax, you will bring it after tax. If it was before tax, you will bring it pre-tax. You should be able to bring your initial capital. You should be able to bring your scrap, and scrap is always an inflow. You should be able to bring your working capital. You should be able to, finally, you should be able to get your net cash flows, and the net cash flows will be discounted. At the end of the day, you will get a net present value. That is the background I thought I could share with you before we look at this question. So back to our question, we are going now to read it while we are going to read through the question while identifying relevant cash flows, because we need to do the internal rate of return. GBL was incorporated in Uganda in 2011 and specializes in the production of soft drinks. Since incorporation, GBL has seen its market share grow significantly until 2019, when it started deteriorating on account of new entrants in the market, in the industry, who offer similar products at relatively low prices. This is background information. Management is therefore grappling with proposals to expand the company's investment portfolio to introduce new products. And the leading proposal is the production of power energy drink that is expected to attract a lot of demand, both locally and in the East African region. Management team is expected to conclude feasibility studies and financial assessment to justify the new product. The following information is so far available regarding the proposed investment in production of power energy. So far, in that paragraph, there is no relevant cash flow. The proposed investment in power energy is expected to generate annual revenue. Now we begin seeing revenue. And be careful, this is in year 1. That is our revenue in year 1, which will be increasing by 8%. That is growth in each, that word is key, in each of the subsequent years, before declining by 5% each year after effective year 4. So that is key. When we are doing our revenue, we need to note that. So our revenue would be picked from that paragraph, because revenue is a relevant cash flow. We are told, additionally, the proposed expansion is projected to have a 0.5% annual substitution effect on the contribution of the company's existing soft drinks, whose annual contribution averages for 9.4 billion or 9,400 billion. So a substitution effect is a cost and it is a relevant cash flow. So we shall need that working. It is further estimated that the variable costs associated with the production and sale of power energy are 55% of the respective annual revenue. So we are seeing here our variable costs are here. So in this paragraph, we have got 3 cash flows. We have got the revenue, we have got the substitution effect, we also have the variable costs. If you have got a variable cost in relation to revenue, then you can get straight away contribution. But on the basis of the company currently, mark the word, currently operating at less than full capacity 80%, the CFO has indicated that, save for the acquisition of the delivery vans, no further capital expenditure in production machinery will be required. He hopes that GBL will instead utilize the remaining 20% to absorb the extra production requirements. Accordingly, to achieve the above revenue projection, it will necessitate to acquire 16 new delivery vans at a cost of 95 million each. The word each is key. This is where we are getting our initial cost with the estimated useful life of 5 years, after which they will be disposed of at 16% of their initial cost. It is further projected that the proposed expansion will increase GBL's annual fixed cost. Currently, the fixed cost currently are at 1.4, and that will increase by 10%. It is very important you understand that this is in the first year of operation, increasing by the expected inflation rates in the subsequent years. GBL estimates that the annual inflation rates in Uganda will be 6%, increasing to 8% in the final year of operation. The CFO has further indicated that the new investment will require additional cumulative working capital, equivalent to 8% of the annual revenue. Ladies and gentlemen, such a sentence, you need to be careful. If your working on revenue is not proper, which ideally should take 3 marks, even your working capital, since it is related to revenue, if your revenue is wrong, you will also lose the 3 marks of working capital. Therefore, you have to be careful with such points, which will be recovered at the end of the proposed investment's economic life. Now, there is this word: all revenues, contributions, and variable costs are stated in current terms. Whenever you are told they are stated in current terms, technically it means they have not been adjusted for inflation. Therefore, all revenues, contributions, variable costs are stated in current terms. are stated in current terms and are expected to be affected by the prevailing inflation rates in the respective years. The proposed investment will qualify for tax depreciation at a rate of 20% on reducing balance basis. GBL pays a corporation tax at a rate of 30% per annum, payable a year in arrears. So we realize that tax is in arrears, meaning that when we are drawing our NPV table, we shall be able to add on another year. Over the years, GBL has evaluated similar investment proposals using the payback period technique on account of its simplicity. However, the CFO has recommended that the proposed investment be evaluated using internal rate of return, IRR, which we need to do, using a standard rate of 14%, which reflects GBL's incremental borrowing cost. So this is what you will use to draw a conclusion. Should the IRR you get goes beyond 14%, the project would be taken to be viable. Aware of the need to diversify operations, the CFO has also recommended that as an alternative investment option, GBL should consider investing in production and sale of chocolate. So they have another product which will generate reasonable profits, although they may require huge initial capital expenditure. It is estimated that the production and sale of chocolate will generate annual net cash flows of 515 million for 5 years, and will require initial capital outlay of 1.7. The investment in production and sale of wines is estimated to generate NPV of 125. It's 5-year period out of the initial outlay of that. However, the CFO has indicated that only 3,000 million has been earmarked for any capital expenditure. The limits on capital expenditure stem from management's unwillingness to raise external finance, since the company is highly geared and there is a fear of sourcing for Islamic finance given the drawbacks. Therefore, this other latest information, this info is going to help us to answer part D, where it says an evaluation of all the 3 proposed investments using profitability index, 7 marks. We should be able to grab all those 7 marks, and I think we are good to start. You can start from any working, but always start with the simplest you can see, or you can go paragraph by paragraph. However, I want to start with scrap and get that 1 mark. We have been told for you to do scrap is 16% of the initial cost. So the initial cost is 95. They are buying 16 new delivery trucks at 95 million each. I rather write that and get my quickest mark, even if it is 1. So we are doing equation 1. We are doing question 1, mock October 2025, MAT ABACUS. MAT ABACUS. And this is paper 15 AFM. Therefore, I've already guided how you would write your report, but I will start straight away with workings. So working number 1, I'm looking for initial outlay. Initial outlay. Specifically, I want the cost of equipment. Specifically, I need the cost of equipment or vans, the cost of vans. We have been told they are 16 vans, each 95 million, and I will do my answers in millions of shillings. When we do that, when you multiply that, 95, give me a second. When we do that, $16 vans each at 95 million. When we do this, if we work out our figures in millions, we should be able to get $1,520 million. Quickly, my working tool could be the scrap value. Scrap value, according to the equation, if we check again, we have been told scrap. So we have taken this sentence here, 16 delivery vans at 95 million each, and the scrap value is 16% of the initial cost. So you should be able to capture these easy marks. So it is 16% of 1,520 million. And therefore, when you do that, your scrap is gonna be 16% times 16% times 1520. Let me put on my calculator. $1,520 times 16%. We are getting 243.2 million. And we seem to be having 2 marks already, or 1.5. So we have captured that. We go back to our equation. I have determined the initial cost. I have already gotten the scrap value. If I wanted, since fixed costs are not connected, we can go back to paragraph 1 and pick, because we have got very many cash flows there. So we can now pick our revenue. So we shall need to do that working. And we are doing working number 3. And in working number 3, we are looking for revenue. All our figures are in millions of shillings. But we should note, they have told us revenue is going to grow by a certain percentage. It will be growing by 8%. But at the same time, we have been told all revenues, contributions, and variable costs are in current terms, meaning that they have not been adjusted for inflation. So since they have not been adjusted for inflation, as we increase the revenue to determine our revenue, you are likely to get your revenue in current terms after factoring in the growth rate. But once you get, which we call real revenue or real cash flow, but we shall need to adjust it for inflation in order to get the money cash flow. Therefore, I'm going to set up my table. Since you are doing the paper manually, a well laid out table would help you. So we shall have our revenue. We are going to have the year. And since we have the year, the revenue, if we work on it, we are likely, first of all, to get our real cash flow or revenue in current terms. So we shall be able to get revenue in the current terms. Then later, you adjust it for inflation to get revenue in money terms. In money terms, I'm trying to have a wider column for revenue in current terms, such that I'm able to pick it very well and adjust everything according to the equation. We are told the proposed investment in energy drink is expected to generate annual revenue of 1.2 in year 1, then increasing by 8% in each of the subsequent years. Let us first write that. So in year 1, our revenue is gonna be 1,200, and we adjust it by a growth rate. We go back. We have been told this is direct. We go back and read the equation. In year 1, the revenue is direct. But we have been told down here, all revenues are in current terms. That means in year 1, my revenue in current terms is 1,200. But I will do inflation adjustment. When I do inflation adjustment, we go back and read our inflation. The inflation is 6%, which will increase to 8% in the final year. So I will adjust this by 6%, and the answer I get is the revenue in money terms, which is 1,272. In year 2, the revenue is going to increase. In year 2, the revenue is going to increase. If we read carefully, in year 2, the revenue will increase by 8%. Therefore, I'm going to have 1,200. I will increase it by 8%, which is times 80. When I increase that by 8%, to get a fill, so you'll have 1,200, you multiply it by 1.08. I will get here 1296. But the 1296 will be adjusted for inflation, 1.06. And when you do that, you should be able to get 1456. 1456.2. Another person could have looked at it and said, okay, I think I will simply say 1,200, adjust it by 8%, and then inflation. Here, in this case, inflation was 1.06, but was appearing for the second time, because this is the first time, this is the second time, and therefore you will multiply it by 1.06 to get that answer. Similarly, one could have said, I rather bring this figure here, since I've already adjusted it for inflation and grow it, let us give it a try and see if we get the same figure. That is having 1272. You grow it by 1.08, then multiply by 1.06. When you do that on a calculator, it doesn't mean you do everything. You do it from your point of understanding. 1.08 times 1.06. You get the same answer. You get the same answer. So take note, you could have said it is 1,200. You grow it, you get 1296. Then grow the 1296 by inflation. But you should not hear I'm squaring, because inflation of year 1 also follows you in year 2. And yet I was looking at growing 1,200. If you don't want to square the inflation, then you should have picked the original the revenue in money terms. In year 3, using the latest, I would pick 1456.2, grow it by 1.08, then multiply by 1.06. You should not, I'm not raising the 1.06 to any power simply because I have picked the money cash flow in order to determine our figure. So if I put that on a calculator, 1456.2 multiplied by 1.08 times 1.06, you're getting 1667. If I round off, 1667.0. In the same way, in year 4, we go back and read the equation. We have been told we are increasing by 8% in each of the subsequent years. But in year 5, we shall need to decline that by 5% in each year, effective year 4. So in year 4, we are reducing that figure, shall have 1667. You multiply it by 95% because we are reducing it. After 95% is the same as 0.95, then we adjust it for inflation. But we go and read and confirm what is the inflation. The inflation increases to 8% in the final year. So here we are still safe. When you do that, we shall have 1667 multiplied by 0.9. I've reduced it, multiply it by 1.06 to consider it for inflation. We shall have 1678.7, and then in the fifth year, we shall bring the 1678.7, reduce it by 0.95, but then there is inflation of 1.08. Here inflation changes. When you do that, you'll have 1678.7, you multiply by 0.95 times 1.08. When you do that, you'll get 1722.3. So you could have used the N approach. N, if someone adopted this, it could give you the same answer, but the most popular is that. And that's what I've used. So that is our revenue. If you do it well, you should be able to capture your 3 marks. But we are told variable cost working, if this was working 3, working 4 is about variable costs. I'm not going to do them here, I will do it in the table. Variable costs, we are told they are 55% of total revenue, of total revenues. And with that I can get contribution. But I will refer, I will check it, I will do it in the table. So I will say refer to the table. That's what I can say. I'm not going to waste time writing out this because we are going to do it in the table as we lay out our NPV table. So we seem to have moved well with the revenue. We have sorted out revenue, but then there is a contribution. There is this annual substitution effect. This annual substitution effect. So working number 5, you could write substitution effect or contribution lost, substitution effect. Or you could have called it contribution lost. Contribution lost. So we draw our table. We shall have the year. I usually leave a bigger space for the sake of doing my working in there, but at the end we're looking for the substitution effect, 0.5% substitution effect. Substitution effect is a cost. Substitution effect. All figures, we are doing them in millions of shillings, and therefore let us go and read. Here could simply put details. Have in mind the other word. All revenues, contributions, and variable costs are stated in current terms. So here we're being told our substitution effect is 0.5% on the contribution of the company's existing soft drinks, whose annual contribution is 9,400. So our 9,400 is our current annual contribution. Therefore, in year 1, or I could put here, I can leave it as details, and that's where I'm gonna do. So in year 1, we are going to have 0.5% of what? Of the current annual contribution. And the question says the annual contribution is 9,400. But this figure is in the current terms, so we adjust it for inflation. And when you do that, the answer you get is 49.8. Therefore, if we go back to the question, we have not been reminded how it will move. And since we are not being told how this is going to move into the second year, we go back and read this point. All revenues, contributions, and variable costs are stated in current terms. So that figure we have was actually in current terms before adjusting it for inflation. Meaning that going forward, I'm going to adjust that figure for year 2. I will have 49.8 and adjust it for inflation. I will end up getting 52.8. In year 3, we continue adjusting for inflation, which is 52.8 times 1.06. We end up with 56 flat, or if you wanted 0.0. But inflation was changing. increasing to 8%, inflation is changing to 8% in the final year, meaning in the fourth year we are still using 6% times 1.06, and we end up getting 59.3, and finally in year 5 we shall have 59.3 times 1.08. Let us read again what inflation is. Increasing 2. When you increase that, you get 64. Such a working can attract 1 mark or 2, and therefore it was a doable working. We shouldn't fear. So we go back to the question. So we are through with the whole of this paragraph. We have sorted out revenues. Sorry. We are through with the first paragraph where we sorted out revenue. We have sorted out the substitution effect, and the variable cost, we shall sort it out in the table when we are laying out. We are now on fixed costs. Students usually have a problem with these fixed costs according to the examiner. We are being told currently the fixed costs are 1,400. I need to pick that in my table. So currently in year 0 is 1,400 million. But then we are being told this will increase by 10% in the first year, meaning that our fixed costs in year 1, there are many ways of looking at it, but in year 1, our fixed costs, which are real, will be 1,400 times 10%. When you do that, you will get 1,040. That 140 is basically in real terms. But we were told we're supposed to subject it to inflation. Therefore, if you adjust it for inflation, you will actually get, you multiply that 40. Let us first go back and read the question. It is further projected that the proposed expansion will increase annual fixed costs currently at 1,400 by 10% in the first year of operation. Then increasing by the expected inflation rates in the subsequent years. So in the first year, we are getting our relevant total fixed cost is 140. It is in year 2, according to that sentence, we go back and read. It is in year 2 where they are saying subsequently increasing by the expected inflation rate. So that 140 must be adjusted for inflation. And how do we adjust it for inflation? We need to be careful. The examiner does not tell us whether it is the relevant fixed costs that are increasing. So in this case, since he's not telling us, we could have done it the other way. The answer remains the same. We could have increased the 1,400 million, we increase it by 10%. When you increase that by 10%, you'll end up with 1,540. But 1,400 here is not relevant. So when we take the difference here, the relevant is 1,140. Now, when we go back to the question, the examiner does not tell us whether we are increasing the relevant. He's simply quiet. Always look for that word. So since it's quiet, we are going to increase 1,500 because it's telling us it is 1,500 that will increase by inflation. And when you do that, you will actually get 1,632. Please note, in this 1,632, there is still 1,400. So you're supposed to do a difference, 16,332, you subtract 1,400. When you do that, you're left with 232. Please take extra caution on fixed costs. They have been a challenge, and students lose 3 marks because of that. So in year 3, still we are going to look for 1,632, increase it by inflation, and when you do that, you'll get 1,730, but the 1,500 is still in there, and when you take it off, you'll get 330. But inflation changes from which year? It changes in the final year, so we are still good to move. In year 4, we shall have 1,730 adjust by 0.6. When you adjust that by 0.6, you will get 1,834. Take off the original figure of 1,400, you will get 434. But inflation changes in year 5. In that case, therefore, you will have 1,834 times 1.08. When you do that, you will get 1,981. Take off the original 1,400, and you will be left with 581. We did not take the relevant. This is what we call relevant. The relevant fixed cost. The question does not tell us to move in that direction. And therefore, that's why we have kept on increasing the 1540 in year 2, because the notes do not tell us to increase the relevant. So we are done with fixed costs. The next is working capital. The CFO has further indicated that the new investment will require additional cumulative working capital equivalent to 8% of the annual revenue, of which they will subsequently be recovered at the end. But there is this word: all revenues, all contributions, and variable costs are stated in current terms. Therefore, if I'm getting my working capital in relation to revenue, the quickest thing we see here is revenue has already been adjusted for inflation. So to me, I would actually get the 8% in cumulative terms and then be able to move forward very well. So how do we do the working? This is working number 7. Our working number 7 is about working capital. The working capital, the table we learned, you'll have the year, then you'll have the working capital required, working capital, required. And then you'll have the increase or the movement. The increase or the movement. And working capital starts from year 0. We have told it is 8%. Even if you started from year 1, you will not have any problem. I can start from that. I can do that. You'll have year 1, year 2, year 3, year 4, year 5. If we read carefully, the CFO has further indicated that the new investment will require additional cumulative working capital equivalent to 8% of the annual revenue of the following year, which will subsequently be recovered at the end. Therefore, in year 0, we shall get 8% of revenue in year 1. Our revenue in year 1 was 1272. You compute and put that figure. In year 2, it will be 8% of 14. We had this revenue computed earlier, 1456.2. We shall fit it there. In year 2, we shall have 8% of revenue of year 3, and our revenue of year 3 was 1667, and revenue for year 3 will be 8% of revenue of year 4. Revenue of year 4 was 1678, and revenue of year 4 will be, the working capital required of year 4 will be 8% of revenue of year 5, which is 1727.3. But we should know we started from year 0, and therefore you will have the recovery. I will pick my calculator and pick 1272 times 8%. If I round off, I will be able to get 101.8. And I will continue with the calculator, and I will have 116.49. Let me use 2 decimal places. And when you use 2 decimal places, this will be 76. And for year 2, it will be 133.36. For year 3, we shall have 134.29. And for year 4, we shall have 137.79. What you take to your NPV table is the movement. What you take to the NPV table is the movement. This one comes here as 101.8. You invest. And then you keep on studying how this is moving. We are moving from 101.7 to 116.4. Therefore, you inject the difference. And the difference here is 14. We are investing. We continue observing. we are moving from 116 to 133, meaning we are investing again. And that investment is 16.9. 16.9. The negative means you are investing, and therefore when you are taking it to your NPV table, that's how you will take it. In the third year, we are continuing to invest because I realize there is an increase of 0.93. And in year 4, the figures keep on increasing, therefore we invest. We invest 3.49. The rule is, as guided by the question, all working capital must be recouped. Recouping is getting it back. Therefore, when you add this plus this figure plus that, you will get 137.79. Here the figure appears as positive simply because you are recouping, getting it back. And vertically, if you add the result, the effect is 0. It means you invested, and after investing at the end of the project, you got back your money. This working takes 3 marks. We are about to conclude. We are left with 1 working or 2, such that we lay out our NPV table. So we seem to be done with this paragraph, and all points above have been picked. We continue identifying other points. They are telling us the proposed investment will qualify for tax depreciation at a rate of 20% on reducing balance, and corporation tax is at a rate of 30% per annum, a year in arrears. So I have my own way of doing this. Those I teach directly will be able to follow, but the examiner also has his way, and other people also have their own ways. But at the end of the day, the result is the same. That is the beauty. So working number 8, we are looking at capital allowances. Capital allowances. And at times this is known as, this is also known as tax allowable deductions. Tax allowable deductions. I will draw my table. We abbreviate this as TAD. So my table will have the year, the details, where I will carry out my working. Then I will have my TAD, which is at 20%. And then I will have my net book value. I will have my tax relief, which I'm looking for actually, or tax saving. And I will end up with the timing. That's how I draw my table. The other people do it separately, but we get the same result. That is the most important. This is the most important. There are very many ways of skinning a rat. And please note, TAD is on machinery. So me in year 0, I bring the cost. There's no TAD. The cost in year 0 is the cost of the machine. We had this figure. It was 1520 in millions. So in year 1, I will depreciate it. 20% of 1520. When I multiply that, 20% of 1520, I will be able to get 304. When I take it from 1520, my balance will be 1216. And in year 2, I will get 20% of 1216. When I do that, I will get 243.2, meaning that I will be left with a balance of 972.8. I will continue depreciating the asset. I will continue depreciating the asset. In year 3, I will still get 20% of 97, 2.8. When I do that, I will get 194.8. And the net book value after that will be 778.2. In year 4, I will get 20% times 778.2. When I do that, I will get 155.6. And the balance there will be 622.8. Now, the way I do it, in year 5, I will not depreciate. I will put year 5, either I'm looking for a balancing allowance or balancing charge. Before I complete it, below the net book value, I will bring the scrap value. If you recall, the scrap value was, we had it at the beginning. Let us check it. The scrap value, it was working 1 or working 2. Scrap value, we had it somewhere. 243.2. 243.2. 243.2. That's how I do it. I will bring here 243.2. I quickly observe when I compare my net book value of year 4 with the scrap, it means we are selling the asset at a loss. If that is true, then this one becomes a balancing allowance. And how much do you claim? You take the difference between the two. So I will pick my calculator and take the difference between the two. 622.8 minus 243.2. The difference is 379.6. Then we look for the tax saving at the normal tax rate. And we shall pick this 304, we hit it with 30%. And when you do that, you'll end up having 91.2. Here you'll have 91.2. And the story will continue. And you'll have 72 here. 0.96, and you will have the next will be 58.38. Then here we'll have 46.68. We are simply picking this figure here, multiplied, because that is the TAD, and therefore you have to claim 30%. So 155.6 times 0.3, that's how we are getting 46. So in the last one of 37, the TAD is 379.6. You hit it with 30%, you will end up getting 113.88. What is our timing? Taxes are paid in arrears. Therefore, this one will be in year 1. Year 2. This is in year 3. That's when you claim. This is year 4. Year 5. Year 6. Therefore, your NPV table will have 6 columns. This working takes about 3 marks. And with workings, you are good to go. Let us see what else. I think we are done. Now we are left with computing This is information in part C, but our focus is part A. So let us lay out our table to get our NPV. And let me look for Excel. I'm going to use Excel such that we get our IRR and conclude with a conclusion. So, Excel, where are you? Excel. My Excel is opening. We are doing IRR, but we have to do our first NPV. So I'm doing here my NPV layout. I'm doing equation one, mock October 2025, and the heading is in net present. We are doing first net present value layout, and we are doing it in millions of shillings, or million of UGX. Shall I have the year? Remember, we haven't done. Shall I have the year? Then year 0, year 1, year 2. We are doing up to year 6 because taxes are paid in arrears. So remember, we haven't done variable costs. So we are going to have our revenue. And the revenue, we can put the reference. It was either working 3. And since it was working 3, we are going to bring our revenue working 3. Our revenue was 1272. I'm rounding off 1456. 1667. We want to get this IR 1679. Then we shall continue with 1722. But we are told I didn't do variable costs. I will do it here. So we are told variable costs. Our variable costs dash, we are told this is 55% of the above. So I will hit the machine equals minus that figure, 55%. When I do that, that's what I get as a negative, and I will drag across. And when you do that, we had fixed costs. You can bring your fixed costs here. Remember to reference fixed costs. Our fixed costs were minus 140. In year 1, minus 232. These are costs. That's why I'm subtracting them. 330 minus 434 minus 584. And we didn't have any other, but we had the substitution effect is also cost. Substitution. We had the substitution effect. It has a working, you bring it on board. The substitution effect was minus 50. Then we had minus 53. I'm putting a minus because they are costs. Minus 59, minus 64. Then when you are done with that, you should be able to get cash flows before, or you could get taxable profits. So someone could have said cash flows before tax. And since I'm in Excel, I will add them up. And then drag across Since we have taxes, then bring in your tax. This tax, remember, tax is at 30%. And it is payable in arrears, meaning the tax of year 1 will go into year 2. The tax of year 1 will go into year 2, and you hit it with 30%. 30%. So the tax of year 1 has gone into year 2, and the one of year 5 will go into year 6. So you'll be able to get cash flows after tax. Cash flows after tax. When you do that, cash flows after tax will be that plus that, and these are my cash flows. I can close off that because I've already, I don't need to continue taking them. Therefore, I will close them off. Then I can bring my initial cost. I can bring my initial cost. My initial cost was known as minus 1520. Immediately get scrap here. Please note the marks could be awarded straight. The marks were awarded straight in the workings. Our scrap was known as 243. 243 point something. 243. Was it 0.2? I'll check again. Then you can bring in. We had the scrap. We had working capital. We had working capital. You take the movement. You take the movement. The working capital, the movement, it was minus 102. 102. Then minus 15. We had minus 17. We also had minus 1, it was like, I'm rounding off, it was like 0.9, minus 3, just round off. Then we recouped 138. Do not recoup in year 6. The year 6 came as a result of taxes being paid in arrears. So we are bringing now TAD, tax relief on TAD. Remember, taxes are paid in arrears. So the one for year 1, you get it in year 2. That's what we indicated. Word 91, 73, 58, 47, and then we recouped. No, we had 114. And I think we are done. When you're done, we shall have the net cash flows. The net cash flows. These net cash flows. Net cash flows. I will add up because some from cash flows after tax up to there. Up to year 6. You will need to discount them. We are getting IRR. You can discount using any. But there was the part B that is to do sensitivity analysis. And because you are doing sensitivity analysis, you will need to pick from the first NPV. So you have to use that cost of capital which was put in the question. So you go to your tables and read it. 1.14 to the power of 0. And then you drag. You include year 6, you can reduce the decimals, and then you get the present values. You get the PVs. And the PV is going to be got by multiplying these two figures. And then I will drag across. Can reduce the decimal to 1. Then I will get my first NPV. My NPV here, my NPV will be the sum of PVs equals the sum of these PVs. And when I do that, that is my first NPV at a discount rate. At a discount rate of 14. I've used 14 simply because I will need to use it when I'm looking for the sensitivity analysis, so you cannot gamble and use any other. But because this is negative, you are supposed to get a second NPV which must be positive. The rule is you reduce the discounting factor. Therefore, you will come here and write the year. You have to, because we are doing IRR, you will pick the year. This is 0. Then you come and put year 1 here. You continue up to year 6. You pick the net cash flows. You don't repeat everything. The net cash flows, we already have them up here. You pick them. After picking them, you discount them. So you discount them at you lower that rate. Someone could have lowered it to 2%. You can run as far as possible. When you lower it, you'll have 1 divided by 1.02 to the power of 0. Don't get tired, we are concluding. You drag across. Can reduce the decimal places. After reducing the decimal places, now you get your PVs. You multiply those figures. After multiplying them, you drag across or you pull. And then get your second NPV, which we expect to be positive. If it doesn't, you repeat again. But in my experience is most people don't conclude, which is not bad. We are lucky. Our NPV is positive. Therefore, we can now compute IRR. I had originally highlighted the formula. It is always the lower rate. So it equals the lower rate here is 2%, which gives you a positive NPV. And our NPV, our positive NPV, is actually 52. Divided by, open another bracket there, that positive minus the first NPV, which we got as a negative. You close again, multiply by, open bracket, we had 14%, subtract 2%, close. And if I make this as a percent, my IRR is close to 3%. My IRR is close to 3%. That's what, if you wanted to increase the decimal places, that should have been your IRR. But you comment. In the exam, you're supposed to do a comment. The comment is to tell whether the project is viable or not. Keep it simple, but sweet. You will be able to say the internal rate of return of 3% 0.33% of 3.33% is lower than the standard internal rate of return of 14%. This means that the project is not viable. This means that the project is not financially viable, and thus it should not be undertaken. Part B, and the last part I will stop here. On part B was to do sensitivity analysis, sensitivity to initial cost. In order to do that, you need to get sensitivity margin. Sensitivity margin. The 4 marks are sweet. Sensitivity margin is gonna be NPV. It's gonna be NPV. You divide by the present value of initial cost, because it is sensitivity to initial cost. Divided by the present value of initial cost. PV of initial cost. Now, therefore, our sensitivity to initial cost, sensitivity to initial cost, it is the reason I used 14%, is going to be the NPV, the NPV, which was negative something. So you have to look for it. I think it is that one. Divided by the present value of the initial cost. The present value of the initial cost. The initial cost should be, we should understand that initial cost is actually in year 0. Therefore, if it is in year 0, the present value of initial cost is always actually multiplied by 1, and once it is multiplied by 1, it will remain that very figure. So I'm dividing by 15, 20. That is the answer you get, but can make it a percent. So it's about the sensitivity to initial cost is about 28%. There is a negative. But what it means, if the initial cost is reduced by 28%, the project will be viable, because the project was not viable. So we can say, if the initial cost is reduced by 28%, comma, the project will be viable or worthwhile. That's what I could say, and for this recording we shall stop here. At least you have gotten an insight. In part B, that's the sensitivity, the 4 marks. Part C, they wanted any 3 techniques that can be used to reduce the level of uncertainty in the investment appraisal. One of them is sensitivity analysis. You can carry out sensitivity analysis. You can use certainty equivalent factors. You can use the risk adjusted cost of capital. You can set a maximum payback, etc. So ladies and gentlemen, the paper was doable. Always pay attention to the theory and make sure you maximize the theory as you prepare for your final exams. Geofrey Karubanga is my name. Bye for now.